These days, it seems like index funds are all anyone talks about when it comes to investing. People talk about how simple and risk-free they are to invest in, as well as, of course, the fantastic returns you will get if you do so. When hearing this advice, many people might believe that this is the ideal financial instrument. However, astute investors are aware that no financial product is faultless. In this video, I'll give you 5 reasons to stay away from index funds. But before we get deeper, if you are new to this channel, hit the subscribe button and the notification bell so you don't miss any of our videos. So, without further ado, let's get started. Unknown to some, an index fund is an exchange-traded fund with a portfolio constructed to replicate or follow the elements of a financial market index. Typically, this is the S&P 500, also known as the Standard & Poor's 500 indexes. An index fund typically offers low operating costs, broad market exposure, and little portfolio turnover. It enables them to use their benchmark index regardless of the state of the market. Renowned investor Warren Buffett has expressed his opinion on the benefits of index funds for retirement savings. As I already stated, index funds appear to be very popular right now, thanks to modern portfolio theory. According to modern portfolio theory, a security's price reflects all available information, and markets are efficient. Because of this, some supporters believe that passive investing, where investors simply buy an index and ride the market, is preferable to active management of their portfolios. Although many people claim that index investing is the best strategy, I'd like us to take a look at some of the reasons why it may not always be the best. Stock prices in many cases can be very rational, and there is also enough evidence that contradicts the theory of efficient markets. Number 1. Vulnerability in economic downturns. As we all know, the stock market has accomplished a lot to demonstrate that it is a long-term investment that is worthwhile. It has, however, experienced its fair share of economic lows. When the market is doing well, investing in an index fund like the one that tracks the S&P 500 will benefit you, but it may also make you vulnerable to losses. Shorting the index or buying a put against it are two options for hedging your exposure to the index. But since they move in direct opposition to one another, doing so could defeat the intent of investing. Number 2. Inaccurate reactions. Mispricing is a common occurrence in the marketplace. If one company in a sector has a distinct advantage over all the others, but all the other companies in the sector move up simultaneously due to the one unique stock, then the group as a whole may become overvalued. The opposite is also possible. Poor performance may be peculiar to a company, but it may also lower the stock prices of all businesses in the sector. A sector's compelling value might be compelling, but in a large market value index, exposure to that sector will be decreased rather than increased. This market-wide misbehavior may be exploited by active management. An investor can keep an eye out for solid businesses that underperform due to factors other than their fundamentals and sell businesses that overperform for the same reason. Such advantageous behavior is not allowed in index investing. A stock starts to have more weight in the index when it is overvalued. Unfortunately, this is precisely the time when wise investors would want to reduce the stock's exposure in their portfolio. This means that even if you think a stock is overvalued or undervalued and you only invest through an index, you won't be able to take action based on that information. Number 3. No control over holdings. As we all know, indexes are organized into portfolios. An investor who purchases an index fund does not influence the specific holdings in the portfolio. You may have an eye on a particular company or business that you aspire to own. You may have done your research and want to purchase a bank or a food company. In a similar vein, you might encounter certain situations in daily life that make you think one business is noticeably superior to another. Perhaps their brands or customer service are superior. You might therefore want to invest specifically in that business rather than in its competitors. In the meantime, you might feel bad about other businesses for ethical or private reasons. You might object to a company's practices regarding the environment or the products they produce. The addition of particular stocks to your portfolio can increase its value, but you have no control over the elements that make up an index portion. Number 4. Limited investing strategies. There are a lot of strategies that investors have used successfully, but buying an index of the stock market might prevent you from having access to many of these smart concepts and tactics. Combining investment strategies can occasionally improve risk-adjusted returns for investors. If you do some research, you could find the best value stocks, the best growth stocks, and the best stocks for other strategies. After your investigations and your findings, you can combine them into a smaller, more targeted portfolio. By doing this, you can give yourself a better return on investment. Index investing will give you diversification, but it may also be achieved with as few as 30 stocks instead of the 500 stocks that the S&P 500 index would track. Number 5. Investing stress. Last but not least, research can be worrying and stressful, particularly during periods of market turmoil when choosing certain stocks may require you to constantly check quotes. You may also experience insomnia as a result of this, but investing in an index will not make these problems go away. You might still find yourself constantly monitoring the state of the market and worrying a lot about the state of the economy. Additionally, you risk losing the joy and excitement of wise financial decisions and current financial success. Some studies support and argue against active management. Some exceptional managers consistently outperform the market, although many managers perform worse than their comparative benchmarks. If you want to take a larger economic perspective, index investing has merit. But there are many reasons why it is not always the best way to meet your individual investing objectives. Wealthy investors tend to steer clear of this tactic. The benefits of investing in low-cost index funds are discussed by renowned investor Warren Buffett. Buffett's advice notwithstanding, wealthy people rarely invest in straightforward, affordable market-matching index funds. Instead, they put money into small companies, real estate hedge funds, and other businesses with high entry barriers. Such risky investments typically have hefty upfront costs, high ongoing costs, and potential for astronomical returns. I'll give you an illustration of how wealthy people invest. Take Steve Ballmer, the former CEO of Microsoft, for instance, who has a net worth of about $52 billion. He no longer works for Microsoft, but he still holds hundreds of millions of shares. About 4% of the company is his own. Ballmer is investing in numerous other businesses and sectors though. He has several real estate investments, for instance, and held a 4% stake in Twitter until 2018. He also owns the NBA team, the Los Angeles Clippers. His wealth is concentrated in a small number of investments, a far cry from the hundreds of investments that would result from following Buffett's advice to purchase low-fee securities. Wealthy investors also enjoy using hedge funds. Investors in these funds must exhibit a net worth of $1 million or more and employ sophisticated strategies designed to outperform the market. Hedge funds, on the other hand, are subject to 20 capital gains taxes and typically charge 2 management fees. Investors must therefore receive extremely high returns to justify such high fees. This doesn't mean that wealthy investors don't own traditional investments like stocks, bonds, and mutual funds, because they do. Their wealth and interests open doors to other types of exciting and exclusive investments that aren't typically available to the average person. The wealthy invest in unconventional financial instruments, as I just mentioned, but they also invest in common assets. However, index funds are still not the best investment option. The S&P 500 returned 9.53% annually on average over the previous 90 years. You'd think that such returns on their investments would satisfy the wealthy. Rich people take chances to multiply their millions or billions of dollars. For instance, renowned investor George Soros once earned $1.5 billion in a single month by wagering that the value of the British pound and other European currencies would decline. Although history has more than enough examples of years when hedge funds underperformed the stock market indices but can still yield for their wealthy clients, this is why wealthy people are more than willing to take on significant risk by paying huge buy-in fees of $100,000 to $25 million for a single investment. Since many wealthy people make their millions through their businesses, they view this as a way to continue expanding their financial situation while adhering to what they are most familiar with in terms of corporate structure and market performance. The wealthy improve their lifestyles by purchasing these luxuries, and they benefit from the value growth of these luxuries as a respectable addition to their net worth. Wealthy people look for unusual investments in the hopes of seeing worthwhile returns because they have significant incomes, net worths, and opportunities. Not all of their endeavors succeed and generate profits greater than an index fund with low fees. However, they are less reliant on consistent returns because they have more than enough cash on hand to get by. An investor like Warren Buffett can get by with a simple investment strategy in low-fee index funds, depending on the returns you hope to achieve and the rest of your financial objectives. It might not even be the best strategy for you. If investing makes you physically ill and you can't do it without experiencing the occasional bump, you might want to stop using this approach. A manager may allay your fears by using one of the most well-liked investments in today's market, the Target Date or Life Cycle Fund, which is created to suit investors of similar ages. If you discover that you are generally a nervous investor who is prone to giving into these emotions and selling when the market is down, a manager may do this. Options are available that combine index funds and mutual funds. Getting the best allocation and glide path for your investments is the main goal of using these funds. You will benefit from a professional actively managing your portfolio while you sit back and let other things occupy your thoughts. In conclusion, investing in index funds has advantages. They aren't the ideal investment that many people portray them to be. And by realizing this, you can better position yourself to be successful in your investing endeavors. Well, there you have it, guys. Thanks for watching. If you're new to this channel, make sure to subscribe and hit the notification bell button to get updated on our latest videos. Don't forget to like this video and drop a comment. See you next time.